Good morning and welcome to the CQS Natural Resources Growth and Income PLC Investor Update. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab that's situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and they can publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Fund Manager Robert Crayford. Good morning to you, sir.
Hi, thank you. And thank you for this opportunity to present to investors ahead of our AGM on the 10th of December. So, I appreciate there'll be sort of different levels of understanding of the fund and or of the company and what we do. So apologies for those that know us more in depth, but we'll do a kind of quick run through on the background as well. As we kind of sort of move through the slides, so we have a quick sort of snapshot here of firstly of how we're positioned and a bit of background on the company. So as you can see here, we kind of have a quick breakdown of how we're allocated, and we'll definitely talk through that in a bit more detail. So you can see, a heavy weighting towards precious metals, which we'll definitely kind of touch on in a bit more detail. One other thing I'd flag there is, we don't have any iron ore. That's very much intentional. So, a clear differentiator versus other funds and indices, and we'll talk to some of our thinking on there. Bit of a breakdown there on performance as well, but we kind of touch on that again on a further slide. As you can see, just on sort of portfolio strategy, you can see, it's showing 113 holdings, but the reality is actually it's a very conviction portfolio, and you can really see that in the high concentration through the top 10. That's around sort of 38% of the portfolio. Also noting the yield, pays a dividend yield, so currently around sort of 3.5%. And then a bit of a background on us as a team. So we run this fund from New City Investment Managers, but that's owned by CQS, which is a $16 billion asset manager, and we are now owned with our larger parent company, Manulife, with about 1.5 trillion in assets and around 1.5 trillion with about 600 billion of that in on the fund management side as well. So I'm Robert Crayford. I'm a geologist by education. I've been doing this a little over 20 years. I've got Keith, who I co-manage on the fund with, and I'll let him give a bit of a background.
Amicable and concentrate on the engineering side.
And we work with Ian Francis, sort of better known as Franco, and he runs the New City High Yield Fund. So, within the New City Investment Managers Group, we have over 500 million in assets across those 4 funds. So, Keith and I co-manage on this fund, but we also co-manage on Golden Prospect, Precious Metals, and Geiger Counter, which is sort of does what it says on the tin. So Golden Prospect is obviously a precious metal mining focused fund, and Geiger Counter is focused on uranium miners, which is a really interesting dynamic, and you can see that reflected in the allocation in the fund here. So here's a quick snapshot of performance. So, what solution are we trying to provide to investors? So, we're acutely aware that resources is very much viewed as a difficult sector for sort of generalists or investors to kind of get exposure to. It's kind of known to be fairly highly volatile. There are aspects to that. So, what we are trying, or what we aim to achieve for our investors, is to try and outperform both the MSCI World Metals and Mining and MSCI World Energy. So the fund itself is globally exposed across regions and across different commodities, and we will allocate where we see the best risk reward, the best opportunities, and in doing so, hopefully lessen that volatility that you get from the underlying subsectors, and over time aim to continue to deliver outperformance relative to those sectors. And as you can see on that kind of 5-year chart, we have managed to consistently do so. And this actually only runs up until early October, and CQS Natural Resources has gained around about another 12% in share price as well. So, what are the key themes for the sector? We think, we think it has a really attractive long-term thematic aspect to it. So there is one of the key things is sort of general underinvestment. So across the sector, we've seen a lack of investment going into new supply. Yet at the same time, we do have continued demand growth, even if we are seeing a weaker backdrop on China, which we'll touch on in a bit more detail. But it's not all about China. India continues to grow strongly. We're still seeing strong growth across the rest of Asia. Africa, while small, continues to see strong growth, much of that driven by demographics. Other aspects which probably exacerbate that are broader ESG constraints. So we're seeing the larger miners and energy companies. They're really constraining investment in new supply. Part of that is shareholder pressure that they're seeing to pay dividends and share buybacks. The net impact of that is that we're seeing less investment into new supply, which ultimately constrains, ultimately tightens balances and supports stronger pricing. A third aspect to that is the energy transition, which we don't want to kind of overplay that hand, but it's incremental demand for many of those underlying commodities, and it's certainly something that we reflect in the fund, where we see interesting opportunities, but it certainly felt quite cyclical in expectations have in periods overshot and then undershot. So we're still kind of early stages of that, but it's certainly an incremental source of demand, and we think provides some very interesting opportunities. So I touched on it earlier, just around the sort of dynamic allocation in this fund, and it very much is a clear differentiator versus what you would see in more broader ETFs or some of our competitors. We very much aim to provide an actively managed fund, and in doing so, kind of allocate where we see the best opportunities. And this bottom chart shows how we have weighted, how we've been weighted over over the last 5 years. So you can see there was a period back in around sort of 2022, so around that COVID period, where we materially increased the energy weighting, and in part that was due to a material lack of investment, real ESG pressures depressing valuations, as many managers were forced sellers, and therefore saw a very attractive opportunity. More recently, you can see that wedge we have reduced that, and that feeds through, or that follows on from sort of broader concerns around Chinese growth, and concerns there, and the net impact that has to demand growth moving forward, which we're very happy to touch on in more detail. But the real beneficiary, as far as allocation is concerned, has been the precious metal sector, where we see some very attractive opportunities, not least because we've had a very strong backdrop and pricing environment for precious metals, but also that we believe the miners themselves have lagged, and therefore see an attractive risk reward in an uncertain global macro backdrop. And we think that, as well as providing sort of strong portfolio insurance, also provides strong upside potential, and ultimately the equities themselves and the miners themselves look attractively valued. I did mention on the uranium side earlier, you can see there with around about 11% allocation. That's certainly something Keith will touch on later, but we think that's a very, very attractive theme as well, and it just kind of gives a bit of a feel about how we dynamically allocate and hopefully provide that solution for our investors. Quick one just on the top 10. You can kind of see there on the uranium side. So our largest holding is a company called NextGen. That's a very attractive uranium development asset in Canada, but we'll touch on that in a bit more detail. And then you can see a fairly notable weighting towards precious metals within the next 4 of the top 5. One thing I would flag with those is that one of the aspects that we see a real attractive opportunity on is that these are producing companies with development assets, and we really feel like development assets are undervalued in this current market. But we also don't want to take the full balance sheet risk of having a developer without having, or we want to limit that exposure at least of having a development assets without strong cash flow to back that. And that's where this sort of strong gold price environment really supports and de-risks execution on bringing through that incremental production that hopefully leads to a re-rate. Below that, we have the likes of Transocean, BW LPG. So Transocean is a large, it's the world's largest offshore oil and gas driller, and then BW LPG is ships propane basically. Main route there being from the US, which produces a byproduct, to Asia, where it then feeds through into their refining complex, and as a cheaper source and replacement for oil. So that kind of shows within our energy exposure, one of the things we quite like is the kind of more activity plays, and this kind of feeds through into that lack of investment, the lack of investment into the sector, which is ultimately constraining supply, tightening markets, and in the case of these two, leading to stronger day rates, sort of longer term. There are medium-term fluctuations to that, and more recently, we had reduced down our BW weighting, just given some concerns around kind of broader macro drivers. And then we have Your Energy just making it to the bottom of the top 10. Again, a uranium name, but I won't cannibalize our presentation later on, so I will move on. So precious metals. Why are we comfortable having as large a weight as we do? And just remembering back to that earlier chart, we've historically had a far smaller weighting towards precious metals. So the key difference here is not just that we've seen gold continue to repeatedly make all-time highs. The real differentiator for us now relative to, say, for example, where we were in the post-COVID period, where we saw gold push notably higher, and you can kind of see that around the middle of the chart here, post 2020, that we then saw, firstly, an increase in revenues. We saw strong gold miner price action. We saw strong gains, but then they gave back much of those gains as they then saw cost price inflation that ended up squeezing their margins. What we've seen from this more recent breakout from around that March period, where gold broke away from its shackles of $2,000 per ounce, and we're now sat around $2,600 per ounce, is we aren't seeing that same issue of cost inflation feeding through, which means that the miners themselves have seen a material shift in improved margins, increased margins, and thus higher free cash flow. So where we're focused in the fund, so the fund itself being closed-ended lends itself very well to allowing us to focus on the best value opportunities rather than those that are the most liquid, which is what you may see in more kind of passive type ETF type structures. So that allows us to really focus on value. This is where I can use my expertise as a geologist, Keith's kind of expertise from sort of 30 years in the sector and long history of knowing the underlying companies of picking out the ones we believe are going to be relative winners. So we think it's very attractive. We think it offers insurance protection, and the sector itself is seeing record free cash flow. This record free cash flow, we believe, will be supportive, firstly in leading to better price performance and an increase in price to NAV multiples, but it will also lead to an increase in M&A as larger producers look to replace reserves that they're depleting, given that the sort of mid-cap and larger producers have materially underspent on exploration and development of their own assets. And also we're seeing kind of more consolidation within the sector as the miners themselves try and achieve sort of greater index inclusion and thus greater liquidity, which is an incremental driver of relative outperformance, given, as this chart shows here, you can see the gold price in yellow, and it breaks out the price to NAV at spot of the different subsectors. And here you can see it kind of breaks out large, medium, small, and the developers. And it does highlight that there remains a valuation discrepancy between those smaller producers. And then within the names that we focus on, we believe we can find even more attractive opportunities than this average number provides. So gold itself, I mean, Keith and I, our main focus is really on the bottom up of, picking the best names rather than predicting where the gold price is going to go. Gold itself can be difficult to predict given the many drivers that are feeding through, but there are some aspects that we think are very attractive. So how do we look at it? So we kind of look at it on the flow aspect and where is the incremental buyer going to come from, or who are the buyers, and how will that continue? So, one thing we've seen post the US election with Trump coming in is that it certainly feels likely we're going to see higher geopolitical tensions moving forward. We've already seen recent comments around potentially following through on his prior stated intentions of tariffs on the likes of China, and a more aggressive stance on how they're going to deal on an international basis. The key aspect for gold behind that is that we've seen very strong central bank demand, as flagged by this bottom chart on this page here, where you can see steady central bank buying for the last 10 years, and we expect that to continue with that backdrop of a Trump presidency. The top chart shows physical ETF holdings, physical gold ETF holdings, and what you can see there is a steady selling of gold holdings since that initial increase post-COVID period in around sort of mid-2020. Much of this is driven, one of the major drivers for this is interest rates and thus inflation and expectations of where interest rates are going to go. So we've had an increasing rate environment, and now it looks very much like, well, we are heading into we're currently in a rate cutting environment, and the pace of which can be debated, and expectations for that kind of are shifting quite materially on a week by week basis. But one thing we can say with a reasonable amount of confidence is that it's certainly anticipated that rate cuts are more probable here than further rate hikes, but we'll have to see how inflation plays out from here. But that means, and we've seen 3 or 4 months of that now, where we had seen steady buying return to the physical ETFs, and that has a real swing delta effect on gold price, on gold price through gold flows on that incremental buying from the ETFs, and we believe that will continue to be a supportive measure going forward, and should support the gold price as we continue. But ultimately, the thing we have the most conviction on is that government and central bank demand should remain resilient moving forward. So energy I touched on earlier, but I think one of our key thinking here is that ultimately renewables are important. They are growing and they're materially growing, but they're still a very small proportion of the global energy supply, and thus we think that there will continue to be a requirement for more conventional sources of energy moving forward, and this is oil, this is gas, this is coal, but ultimately coal will be phased out. But I think expectations of it being phased out were perhaps over ambitious in the West for Western investors, and the reality is that much of this transition will take longer to execute on than was being implied within equity valuations, and certainly the investment approach from companies more broadly. We really think gas is going to be one of the major forms of energy through the transition, and the main driver behind that being that even as we see increased loadings of renewables, you get to a peak ability of renewables to supply into the grid, and that typically comes at around 20% until you start to see material additions of grid storage, which we just haven't seen sufficient investment in, and thus we don't see that as being an easy solution that's going to solve the world's power shortage in the near term, and thus we think there's a very important role, at least for the next decade, if not many decades to come, where fossil fuels are going to continue to feed that gap. The only real ultimate solution on a sort of zero carbon basis would be uranium. But again, that will take a number of years to play through, and we think there's a real opportunity within many of those underlying names. Although we have taken a bit more of a cautious approach, given especially on oil, given that kind of weaker Chinese backdrop. But as I said, we kind of see more interest in more opportunities in those activity plays, such as the drillers, because a real lack of investment into those have tighter markets and led to high day rates, high returns, and many of these companies are focused on dividends, which is supportive for us in paying out our dividend. Again, I mean, a bit more detail on that. I think we are definitely kind of moving into a world where we're seeing a slightly slower growth rate on oil demand. But again, to that point, I think it's important to just appreciate that gas is going to be one of the key balancing aspects in this transition. And again, the activity that comes with that. One of the key questions around the direction for oil price is going to be actions that we see from OPEC. We have continued uncertainty with wars on multiple fronts. We are seeing potential off ramps for a number of those conflicts, particularly coming into the Trump presidency. But either way, there's still a number of uncertainties that could lead to volatility, and thus we think it's an attractive sector with many of the underlying names trading at huge discounts relative to other sectors, given those sort of perceived ESG pressures. But it really feels like we're seeing the whole discussion around energy as a sector really evolve, and a realization that it is required, and thus we're seeing a softening tone from the political backdrop. I think you're on mute, Keith.
Yeah, don't know how thanks.
Yeah.
Taking it on from there, thanks, Rob. Energy is a key theme within the trust, and I think one of the points I would like to reiterate is that we try and take a pragmatic approach as to how that is addressed. And certainly when we were coming into COP26 a couple of years ago, we felt that policies were unfairly penalising traditional forms of energy in the fossil fuel sector. But we do like thematics. One that we also felt was being almost deliberately ignored because it was quite a hot potato at the time was the nuclear power sector, and it's one which now figures quite highly as a central policy measure around the world, with COP28 and more recently COP29 really highlighting that fact that it is core, pardon the pun, to the energy transition as a clean form of baseload power generation. The crucial fact in this sector is that we like the fact that there is a supply shortage of uranium because there has been over a decade of underinvestment in the sector, and that is something which is a fundamental point that we generally look for. We've seen reactor lives extended as part of the new policy measures that most governments globally are adopting, on top of which we're seeing considerable rollout of new reactor capacity planned over the next few decades, as a result of which the supply shortfall that was already in place over the last years is widening again. One, I think, crucial point that we must also get across from this is that very often we'll have the point raised directly at us, well, we've missed it, uranium price has moved up. I think that's something that we do need to talk about more publicly, because frankly, when you look at the life of a reactor and the levelized cost of electricity produced from a reactor, uranium only represents some 8% of the actual cost of producing electricity. If you look at the comparisons of, say, a gas combined cycle reactor, even with current gas prices, which have come back from the Russia-Ukraine and energy crisis peaks, we're still talking gas prices up something like 60% in many places, and typically that represents around 70% of the cost of producing power. So utilities ultimately are very insensitive to the price at $100. Even 150, they're not going to close a reactor for the sake of an extra £5 or so million a year of fuel, and that is something which will sustain the typical lengthy uranium cycle. And at the moment, the time taken to bring new supply on as is going to be required towards the end of this decade and moving into next is long. For that reason, we've, as you saw on one of the earlier slides, positioned the portfolio into tier one asset, which has strategic importance in that it can be flexible in its production, it's unhedged, it has expansion along a trend corridor in a well understood uranium, one of the most extensive uranium mining districts in the Athabasca in Canada, and that will be something that figures at the fore of, I think, most utilities mines when they go looking to sign off-take contracts, which we expect them to re-engage with in the near term. But as a result, ultimately, this is a sector which is probably less exposed to some of the more cyclical risks of other industrial metals, certainly because governments are very keen to ensure that the rollout moves forward. And as I say, we are exposed to that quite nicely in terms of the portfolio. If we look forward another slide, and sticking with the energy theme, just to give a flavour, this is the lithium price. We do like, commodities that feed into it. This is one that often really piggybacks off this talismanic EV. And we saw an investment called Sigma Lithium some time ago, which was one of the highest grade resources globally. That was just at the beginning of this chart. The green line shows you the lithium price benchmark. It was high grade. It was looking to produce considerable amounts of lithium in Brazil, and it went from being something like 2% or so of the portfolio up to one of our largest positions at the time that lithium price moved up to $80,000 a ton for carbonate 6% benchmark. At that time, though, we just felt that for choice, we were starting to see an awful lot of projects come back on. Again, going back to the supply and demand dynamics, we felt that maybe too much was coming on. And having seen a good re-rating of the Sigma share price from, say, $2 to about 50, we largely exited that position quite fortuitously with hindsight. That price has now come back down to the point where we're starting to see some of the supply expansions being curbed and actually supply coming offline. It's a question of timing and relative valuation to what else we're looking at the moment, but that's the type of sector that is starting to screen out now. It's really just a question of timing as to the extent to which we might get back into it. But as this slide really points out, this all falls into the larger picture of how we see the energy sector. We like copper in the longer term. We'll come on to that in one of the next slides. Nickel may have a role to play, but lately, basically, we've got more nickel units being produced in ferronickel, which is the nickel pig iron that's coming out of Indonesia, which is just keeping a lid on that one for the time being. And we do like batteries, as I think was sort of briefly highlighted earlier, but that tends to be more technology dependent, but could certainly play a role in stabilizing grids as we move to try and absorb some of the more variable renewable powers. But we just don't really see the opportunities at the moment. For choice, we'd rather go in for the plain vanilla coppers at the right point in the cycle, but we just feel at the moment less inclined to do so. In fact, we are keeping that at the low end of exposure generally for ultimately this reason. We've got 6% in base metals, but if the key chart on this page is that lower left one, and here we've got a black line which shows you Chinese property completions, and superimposed below that is an orange line which shows you starts. Now we've tried to get the line of best fit between when projects are started and when they complete. That fits best when we shuffle this orange line forward about 2 to 2.5 years, and it's hugely negative. We're seeing, property starts down something like 70–80% still, and that really just gives us a poor outlook for the use of industrial metals in that sector, which is one of the biggest components of demand for metals. Certainly that's the case for iron ore, and is for that reason, that sector we don't invest in. notwithstanding the fact that you could invest in that directly more cheaply yourselves with the likes of Rio or BHP. But it also is a big end market for copper, and things like air conditioning units and wiring that go in fit outs are over a quarter of China's domestic demand. We have seen the largest global buyer of copper, which is the Chinese State Grid Company, starting to substitute into things like aluminium, which are still in excess capacity of production, basically out of China, which produces something like 60% of aluminium. But the point is, for the time being, with the property sector so depressed, we're not really inclined to go for copper mining equities, which is still trading at premiums to their NAV at spot copper, where we think just for the intents and purposes, there's probably a little bit more downside risk to upside on the outlook for timing. But we would look to get back in if we saw the valuations perhaps correct to more meaningful levels. But I think that gives you the flavour as to why we're not into some of the industrial metals. Copper would be the one. China doesn't own that, and it would look to put its foot on assets. It has been some of the biggest exposure that we have, but I'll come back to that later on. The main point is that for the time being, we see the route out of the rather muted growth, aggregate growth that we're seeing around the world as if anything, being fueled by more government spending and higher government debt. And that is something which keeps bringing us back to gold, where we quite frankly just see the best valuations, as Rob succinctly put earlier. If we jump forward to another sector, and this is really related more to the activity plays on energy, again, that Rob outlined earlier, in some senses similar to commodity supply, there just hasn't been the moves to increase capacity in the shipping. And in particular, we look at, for preference, shipping of energy where it's in many places produced to a surplus, such as the States, and isn't produced well to any degree, particularly in areas like Europe. So it's getting it from A to B, and that sort of is captured by the shipping rates in a sector which is seeing order books at all-time lows. So that's a sector that we've certainly benefited from the revision upwards in the value of ships, and equally in terms of the day rates reflected into cash flow to these underlying operators, and has been one of the bigger contributors to dividend income over the last couple of years. That said, even now, having had steel prices move up despite some of the issues that we've seen, the NAVs of some of these shippers have been looking a little bit rich, for which reason we've actually been taking some off the top of these latterly, and just actually taking gearing down more generally, again with a view that keeps the concentration of the precious metal sector slightly higher across the broader portfolio as it happens. And then in conclusion, I think I would just really just highlight that some of the attributes for this fund, again, reiterating that we're closed end. We really feel that that lends itself to investing in some of the less liquid assets. We don't really want to follow the beaten track into the large caps. That process actually has much more attractive valuations for our investments. I think the other fact is that we like to view it as a flexible mandate, as we've outlined, or at least attempted to, as I think it was on slide 9. The exposure to individual sectors does vary over time, and we think that is an advantage to sustaining returns, sometimes in what is perceived as a generally more cyclical sector. Gold is currently the highest one because it's got the benefits that we think of people focusing in on perhaps excessive government debt, which looks like it's going to be perpetuated. It won't no doubt be long before we see the US debt ceiling discussions entered into again. We've got black holes in the UK, and ultimately it's a hedge against fiat, and for that reason, it's been one of the strongest sector contributors to the fund. We like investing in thematics. We've outlined how the sectors that we currently feel are best placed to offer returns at the moment. But again, just to give a flavour, if we jog back a decade, copper was one of the biggest exposures that we had, and the top exposure was to a company called First Quantum. After that, we liked the energy theme, and in particular that benefited Sigma, but simultaneously we were also pragmatically in the fossil fuel sectors that have been criminalized by the likes of most governments, and certainly COP26. And that has been similarly one of the bigger dividend distributors. And I think that should give you heart as to probably one of the softer issues, which is actually we've got a lot of experience with this, not just Rob's geology or my sort of engineering bent, but a few grey hairs, having covered lots of sectors in the market, including this one. We just have a little bit more of a top-down sense. You're being paid still a dividend of 5.6 underlying, and we do pass through some of the specials that we've received. I'd say for choice at the moment, given we're allocated more to the capital growth sector of gold, that will be less of a factor in the nearer term, but still looking to maintain that 5.6 dividend, and we've topped up our reserves to the maximum allowable over a number of recent years, so we feel very well placed for investors. And I would from there probably just open it to questions, unless Rob has anything, other closing remarks.
No, I mean, I think we can kind of touch on things. I can see a few of the questions coming through. So, yeah, I think if maybe we conclude the formal part of the presentation there.
Robert, Keith, thank you very much for the presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Just while the company take a few moments through the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, and as mentioned, we have received questions throughout today's presentation. And Robert, Keith, if I could just hand back to you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Okay, great. Well, I'll work through in order. Assuming the slides are all working okay, I'll flick back to the slide here. So the first question that I have here is, what are the biggest risks to the portfolio and how are they being mitigated? So I'd start with that and probably say it's the large exposure that we have to precious metals. So, clearly that's quite a conviction view that we've taken. Our reasoning for that is, firstly, the gold price has moved up notably, and we believe that the equities themselves have notably lagged that. So are in effect implying a precious metal price that is below where the current spot price is. We focus on companies with strong balance sheets. We focus on companies that we think are relatively undervalued relative. In the sector overall, with its strong free cash flow, we think kind of dips in those names generally, if you do have that, would just probably drive more M&A interest. So we think that kind of provides a defensive aspect. Now, I guess the key risk is if you had a major correction in precious metal pricing, how would they react? So again, that's kind of where we take that caution around balance sheet. We have been certainly trimming, taking profits on a number of those larger names you saw in the top 10, such as Westgold, Emerald, etc. Just as they've kind of continued to push on and get a little bit larger on individual position sizing. So, again, it comes down to diversification, our extensive experience and knowledge of the management teams themselves. So, knowing which management teams to trust ultimately, the ones with skin in the game. And again, it comes down to asset and jurisdictional risk, which is probably a good segue for the next question, which is how diversified is the portfolio geographically, and are there plans to increase exposure in regions with strong commodity production potential? So the right-hand chart there shows our country or our regional exposure. So you can see we have a fairly heavy weighting towards North American and Australian assets. So that is kind of perceived tier one. Key reason for that is we don't think valuations in the sector are overall generally stretched, and as a result, we're not being pressured to go into or kind of heavily weight towards the perceived tier two, tier three jurisdictions. Now, that said, we do want to be kind of clear as we are not against going into jurisdictions outside of the perceived tier one. And the reason for that is perceived tier one actually, as an operational sense, doesn't actually translate into in many cases being tier one. So particularly for, say, development assets, if we look globally, the countries we particularly like at the moment would be places like Guyana, where you have a very supportive government towards both mining and energy. Very much progressive. Where actually, if you look to sort of more Western economies, it can be very difficult to bring through projects, expand them, and ultimately deliver returns to shareholders. So, within that, we're very dynamic in that view. There's a valuation that makes sense and one that doesn't. But at the moment, we think jurisdictional risk is often overly priced within the market versus the reality of the actual underlying risk. So we're kind of dynamic in that view. Clearly West Africa itself has deteriorated more recently with multiple coups and sort of jihadi involvement. So we had notably reduced our African exposure. But ultimately, we think kind of over the medium term, they are good places to operate as they have supportive governments, heavily reliant on mining as a major source of tax revenue, and therefore aren't bad places to operate. But again, it comes down to valuation, opportunity, and catalysts, and it's really about risk reward. So, what is the downside risk? What is the upside risk? What is the upside potential? And then we kind of size accordingly around that into trying to produce an overall portfolio that generates the best returns, but minimizing kind of specific risk where that is heightened, potentially taking smaller positions because often the reward is commensurate with that downside risk.
One of the other questions that we've have here is you reduced oil exposure in light of weaker Chinese demand. What indicators would prompt a re-entry or increase exposure in this sector? I think that would come back to looking at one of the factors which has really weighed on it lately, which has been a slight slowdown in demand out of China. I think we have to be within that wary of different drivers because clearly energy is quite strategic. If I don't know that we're necessarily smart enough to call the timing of possible flare-ups in terms of conflicts that are going on. But I'd say for the time being, there is, if anything, probably more risk that any conflict premium certainly stays in the share price, if not possibly increases, should sanctions be imposed when Trump is inaugurated in January on the likes of Iran, possibly Venezuela. But the main driver beyond that will be looking at the improvement in ultimate demand for this commodity, which will probably be driven in some way by China. If we saw actions that would prevent some of the entrepoting, the wheeling of power bought cheaply by the likes of India, semi-processed and export, then that would close a door, I think, that would probably put prices up more broadly. And is something that we monitor. At the margin, we've still got the strategic petroleum reserve in the US to refill, but I don't think that's going to be too significant, but at least it's something.
Yeah, I mean, and maybe add to that. I mean, it's also about pricing. Where we are, I don't think you're going to deep into any kind of cost curve, so we're not seeing any kind of supply discipline or rationalization here. US shale continues to run at what we expect to be probably a more kind of flat level. We'll kind of see what comes out of the shift in US politics of whether their aims of increasing US oil production really come to fruition. I think we're a bit more suspicious of whether that really plays out. So we kind of take a bit more of a kind of flat US production type view. But if oil kind of fell more down towards the kind of mid-60s level, I think you start to move into the cost curve and some of that US shale production. That could lead to a bit more rationalization. But ultimately, I mean, it's the view here. It's more about near-term concern just on China, given those concerns that we have of the Chinese property sector, which we think will take a period to play out. The risk of US tariffs on China could knock, if the larger numbers that had been stated of around sort of 60% tariffs on China, if that were to play out, that could have a material knock to Chinese GDP, which again could have a knock on to demand. And we are also acutely aware that Chinese car sales now are materially shifting towards a much higher proportion of EV sales. So that's why we're kind of getting to a much sort of slower growth environment moving forward. And then the next question is really about which ends up winning out, EVs versus hybrids. We do think there's going to really, particularly across emerging markets, continue to be a large role for hybrids, given they simply don't have the power infrastructure and charging networks. Thus, in that transition in car design, we think hybrids ultimately remain a winner, which then feeds through into continued oil demand, albeit at a slightly lower level. Also feeds into things like PGMs, which hugely depressed and a bit contrarian here, but could create an interesting opportunity for them there. If I jump on to our next question, so how do you size your positions? For example, how do you set price targets for each stock, implying that NextGen Energy has significantly larger upside than your other holdings? Well, I kind of touched on that a little bit earlier. It's about kind of risk reward. So what is the upside potential? What is the downside risk? If they're hugely volatile in either direction, typically in both directions, typically we would take a smaller position. Why is NextGen so large? I guess it's just high conviction in the underlying sector and direction of the uranium price. We think, as Keith touched on, I think nuclear is the only real source of zero carbon baseload power, but it is the only source globally. Political support for reactors will continue. So Western reactor life extensions, but really it's driven by growth out of Asia, and we think that will continue to support uranium price. And NextGen is just far and beyond the best undeveloped asset globally, not just in uranium. I mean, almost any mining project, if you put it in a copper comparison, it'd be running at 50% copper grades relative to most mines now being built at 0.6% copper, 0.5% copper in the likes of Chile and Peru. So it just kind of puts that in perspective.
There's another question here which says, within your recent report and accounts, the only risk assessment that increased within the market sector and geopolitical risk assessment section was, in quotes, demand for the company's shares. What does this mean? I think that just means, to what extent the discount is present. If people lose faith and the discount widens too much, then that can raise questions in itself as to what is the raison d'etre for the fund. There's a follow-on bit that says, relatedly, since the year end, the largest shareholder, Saba Capital Management, has increased their stake from 14 to over 19%. What is your relationship with them? Well, we don't specifically know what they think, but in the recent conversations that we have been privy to, and I think we are one of the few funds with which we have managed to engage with them, they seem quite happy with our performance. Certainly that is something that has probably contributed to the narrowing in the discount that is currently, I think, looking at yesterday's NAV at about 2 or 3%. We have to wait and see. We're not privy to their day-to-day thinking, but so far our interactions with them have actually been, I'd say, non-confrontational, which probably we'll see how things develop. Ultimately, we can't really preempt anything that may result from that. So far, things have not been such. There's a following question: how do you play the need for batteries to stabilize the grid? I tried to touch on this without going into too much detail. I did physics. We do like lithium, but generally the energy density of lithium lends itself better rather than to fairly heavy cars, which actually increase on average by about half a ton by using lithium with still limited range. We have to look at the technology aspects behind that, and that opens you up to another level of technological risk. And for choice, I think we would rather play things more agnostically from where the electrons come from and ways to store them, and just say it's actually the delivery mechanism, copper particularly, which is one of the the ways that we would play that, as I outlined, really, despite what is a still for balance more muted outlook for copper demand, and therefore probably copper prices, which have been drifting lower as we'd expected. And valuations of the underlying equities are still relatively rich in that context. We're not prepared really just to go back into that preferred sector, but we will look at lithium again. Outlined that supply is coming off because we're already at the cost curve, and those sort of cost curve factors are things that we do take. Rob raised the point in comparing electric vehicles with the internal combustion engine, and we talk of precious. And I think just to give a flavour of our sort of investment style in the context of our outlook, muted outlook for things like steel, one of the things that's been keeping PGM prices or production up is a chrome credit. PGMs are used in auto catalysts for the combustion engine, demand for which has been questioned, but we're now prices have fallen. The only thing that's keeping many of the big producers, which are generally based in South Africa, alive is a chrome credit. Now, if steel starts to fall, that chrome credit might ease back, and therefore we'll see some supply rebalancing in that sector, which we think could be good news if you're in the right investments. So for that reason, don't be surprised if in looking for bad news, there are opportunities for good news. And we have started to dip our toe into some operators that are still making profit even at these levels and are not reliant on a chrome credit, certainly to the degree that others are. And I think that is just a sort of style that I would like to get across.
I might add a touch on that. I mean, just around that sort of question around batteries to stabilize the grid. I mean, I think there's a real broader discussion there around what is an economic energy solution going forward, and there isn't just one easy solution. We touched on gas as being part of it, but batteries are certainly required, and we think renewables, increasingly renewables, should be looked at with batteries alongside to kind of balance that. So where does that lead us? That makes solar more interesting than wind, because solar is at least predictable on a day-by-day basis, and season by season basis in the UK. But if we look, more recently, we've had some periods of Dunkelflaut where you've got very low wind and low sun, and that's kind of led to a real drop-off in renewable generation across Europe, and that's a fundamental issue. But where we kind of see it making the most sense would be solar along with batteries. Battery technology has been underinvested in, but ultimately, batteries have to be cheap to make the economics make sense. The first batteries that go in make the most sense because you have the most extreme swings in pricing, and thus in the electricity pricing, thus make the largest arb effectively. But really, I think the real shift in battery technology is going to be when we get a more wider spread of sodium-ion batteries, which should be coming through in around 2 to 3 years, certainly the earlier versions of, and then you'll get far cheaper batteries that could then be used to stabilize the grid. When we look to solar, we think things like silver are kind of major beneficiaries in that. We think in the near term, gas ends up being kind of a major balancing source of power, but ultimately it's very difficult to get to full renewable loading, and thus we think you have to think a bit more holistically around what that ultimate energy balance is. But then we come to things like smart grids, etc. It's certainly a far more complicated and nuanced topic, but I think there's many solutions that all come together and ultimately lead to that overall transition. But we just think it's going to take a little bit longer than has been communicated by some politicians. If I jump on to the next one, could you provide an indication of the current level of revenue reserves, please, and the confidence on maintaining the dividend? I think firstly, the fund mandate, we had the articles changed. we suggested to the board, and the board changed it, that the dividend doesn't need to be paid from income. So that was done back in 2015 to allow Keith and I to have more flexibility around taking a more total return approach on the fund, rather than just chasing the highest yielding assets, because at that point the dividend yield was far higher because the assets were far smaller. Given the strong performance in the fund, up multiple 100% since then, that the dividend yield has effectively compressed, albeit stayed at the same level. We certainly think it's a far more sustainable level here, but as we don't have to pay out of income reserves, we don't view any risk. Ultimately, this is a board decision on where they set the dividend, but it's certainly from our point of view, it's very comfortable here. The fact that we don't have to pay it from income allows us to focus on the total return for the fund, and that will continue to be the primary focus. And given we can pay from capital, there's no constraint on that, and no constraint in how we view investments. And I think that addresses the next question as well.
And there's one here: we maintain a long tail of holdings. What is your rationale behind this? I would just note that we are required to report each. We might have multiple lines in an individual company, so not only a Canadian line but a US line, which might have a differing liquidity and different days of trading over sort of bank holiday equivalents. Equally, we might have multiple tranches of options that, again, in small placements of companies that we would look at, we'll often get a placement unit, which includes a half warrant, sometimes a full warrant, and each of those is reported as its own line item. So the number is quite substantially reduced if we consolidate those into the underlying issuer name. I'm trying to think what the number would be. I don't have it off the top of my head. I would guess it would reduce the number by something like 30. That still means we've got a tail, but a lot of those are things that we are addressing. I'd say note also that in the gold sector, it's a lot more fragmented than, say, the iron ore sector, which is at the other end of the scale in terms of having a cartel, or even the uranium sector, where there are only about a dozen sort of names that you would recognize probably. And for that reason, our heavy gold exposure means that we're generally slightly more fragmented in that allocation to that sector as a result. And that contributes, something towards that very subjectively. I couldn't really put a number on it. But it's not like we just invest in 2 names to get gold exposure. We invest in maybe 20. So figure that out how you might. I hope that kind of addresses it. But we are relatively concentrated, and I think that top 10 holdings gives you some flavour for that. I hope that answers the question.
Yeah, and I think it also comes back to some of those earlier questions as well. It's about risk reward. So within that, you have some within the tail, you have some names that could increase materially, but also have a bit more downside risk. So as a result, are sized smaller. And it also feeds back through to the discussion around copper and base metals. So where we have materially decreased the copper mining exposure because of our broader concerns around end copper demand. We felt too many sort of generalists had kind of come into the sector, valuations looked extended, and we saw more downside risk in the near term. At the same time, given the sort of energy transition and the way things are heading, we have far more conviction on copper out over the medium term. So call it out 4, 5, 6, even 10 years out from now. So within that tail, where we would have reduced one more meaningful copper producer, one copper miner, we bought 3 or 4 copper developers which have assets that trade at a material discount to NAV, because the market currently puts a huge premium on producers over developers. Yet if copper even remains halfway as optimistic as the producers are pricing in, then ultimately these development assets end up being the next major M&A targets. And within that, you see names in the fund such as Solaris, which is a multi-billion ton deposit, a true tier 1 scale copper project in in Ecuador, assets like this can increase many multiples just to get to kind of a fair value as they de-risk into production. But at the same time, the downside risk or the risk of having to do further equity issuance, dilution, and the support from underlying shareholders is also higher. So as a result, we size them smaller, but at the same time, it doesn't mean they can really offer kind of outsized returns relative to what is overall a smaller overall weighting in copper miners or copper developers overall.
And I do like that point actually, because I would like to highlight that we do try and look at things through a different perspective, and through a cycle, there are points when it can be advantageous to look at developers or not. And certainly when prices are going up as they have done post-COVID, for choice we would rather not be invested in developers where there's a greater risk of cost overrun. And I think that ties in nicely with Rob's comment there, that at the moment no one wants to touch developers because of that perceived risk. And these are projects, Solaris and the likes, where we look at the asset, it doesn't seem to have much arsenic, which is something that afflicts many new copper developments. So fundamentally, it's looking good. The scale is hugely attractive to big players. At some point in the future, these are district scale plays, and they're crushed in terms of valuations because they're just seen as unfunded developers. But at some stage, that will come back in, and we dip our toe into these things because we feel that's where the best risk reward is. And again, I hope that gives you a flavour for our approach to investment. We're not trying to just look at top down, bottom up, but we also look at it from the side as to where in the cycle, what state of development these assets might be. At the moment, we're still in producers probably because it's probably still cheaper to buy than build in those sectors that we are invested in.
I'll take on the next question. So, do you see much value in royalty companies, precious or base? So, this is an interesting one. It's actually an interesting question. So, we do have some exposure to Wheaton Precious Metals, which used to be Silver Wheaton, which is a precious metal royalty company. The view here. So, do we see value in this case? They trade at a premium to NAV, but through that royalty structure, then they get further upside through mining life extension. I think for generalist investors, they're a good investment, and and a good way of getting exposure to multiple names without having to take specific mine risk, and it kind of reduces some of that volatility and exposure. Whilst at the same time, they being a royalty or stream, they don't have the same cost inflation pressure issues. So, we're currently having a debate between the two of us. So, at the moment, there isn't the same benefit from having that cost inflation protection, because cost inflation pressures in mining have materially eased. Similar to where we had heavy cost inflation pressures ourselves, as we've seen that across energy, etc. Now it's far easier for those producers. So you don't get that benefit. But on a multiple basis, they generally don't look too extended or too stretched. But I think our kind of major concern for it would be, given generally strong balance sheets across the sector, particularly very strong free cash flow generation across the precious metal sector, that there's little motivation for mining companies to enter into royalties, given effective strong balance sheets and strong sources of funding within the industry. So that makes the opportunity for incremental royalties for these companies far more difficult, and thus far more competitive, and they're being priced quite aggressively. So some pros and cons. We think they do provide a good diversification aspect for certainly for kind of more generalist retail investors. We kind of take a view with our exposure of where we see kind of incremental flows coming from, and we do think for the likes of Wheaton Precious that that could ultimately go to a greater premium as we see generalists kind of flowing back into the precious metal sector, given the strong performance of the underlying metals. And that concludes on the questions. So we are over the hour. So I think maybe we'll wrap up there. But thank you very much to everyone for taking the time, and especially if you've hung around till the end of the call.
Perfect, Keith. Robert, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CQS Natural Resources Growth and Income PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.